Good afternoon, and thank you for joining us for our Q1 Manufacturing Outlook webinar today. I'm Richard Austin, BDO's National Head of Manufacturing. Welcome to the webinar. Obviously, this is the first outlook that we've done of 2025. There's a lot of news out there at the moment from last week, and obviously the launch of our quarterly reports yesterday as well, highlighting the fact that manufacturers are very much navigating a landscape with some old challenges that we probably discussed quite a few times in the past, but some new ones as well. Principally among those kind of leading through to uncertainty in the market, but also rising costs as well, especially following the autumn budget that was announced last year. Increases in national insurance is obviously starting to take its toll, or at least in terms of people's planning. We'll take you through that, and James will pick up on that in part of his commentary as well. But it's leading to a decline in confidence in the market as a whole. But it's not greatly a surprise, I think, in terms of the news that's been coming across over the last 3 months at least, and since the autumn budget as well. With that, we're thrilled to have James join us again. James Brougham, Senior Economist at Make UK, who will be joining us to talk us through some of the results and some of the details and nuance associated with that as well from the latest quarterly report. So welcome, James. Thanks very much for joining us. On top of that, and just after that, we'll be hosting a panel discussion, which is really going to focus on financial resilience. One of the things that obviously some of the results that are coming out is showing is that in terms of intent and how to manage your business through potentially ongoing uncertainty plus additional costs on overlaid for manufacturers, there's going to be a far greater focus on looking at financial resilience and maintaining performance through what could well be quite a tricky year ahead. So fantastically, I'm very pleased to say we're going to be joined by Richard Dammermann, who's BDO's Head of Cash and Working Capital, and also Stephen Cooney, who's a principal in our Value Creations Services team at BDO. So as I said, during that panel discussion, we'll be really focusing on challenges, expectations for the year, looking at working capital and operations across the manufacturing sector, and showing some insights in terms of what we're seeing in the market as well associated with that. And obviously, you know, as we go through that, there's a role that technology can definitely play in terms of performance. The question is, how do you ensure that you've got sufficient investment to do that over a reasonably short period of time? As usual, there's live Q&A as we go through the session today as well. So please do submit any questions you may have into the Q&A box at the bottom of your screen, and we'll pick those up at the end. And those can be for panelists, but also James as well will be joining for that as well. So we'll pick that up towards the end of the session. With that, I will hand over to James to take you through the latest results. James, over to you.
Thank you, Richard, and good afternoon, everyone. Well, here we are, the first outlook of 2025, and I must say it's been particularly for those of you that are perhaps fans of the series, for lack of a better word. You might know it's been quite confusing, especially when we consider last quarter data at the end of 2024, because I think it's relevant as to what we're about to see here. We had a bit of a surprise seasonal shock, a positive shock, for lack of a better word, in terms of the data that came in with output and orders delivering sort of slightly above expectations, and indeed we'll talk about it in a moment, but the sector has been consistently underperforming as per its 3-monthly expectations, except last quarter, so that wasn't quite the case. This quarter, we're back to business as usual, for lack of a better word, in terms of that slight over-optimism with how much, how positive output and orders are compared to where they actually come in. But we do see some softening in the downturn, the quite sudden downturn in confidence that we saw last quarter, which added to that confusion. We had the biggest downturn in confidence, in business confidence in the manufacturing sector in the UK that we'd seen for quite some time. I think just about over 2 years. Yet at the same time, we saw some of the biggest growth, the short-term growth in the output and orders metric that we had seen. Coming to this quarter, it's calmed down a bit. No extreme shocks either way, but certainly we're still in that territory, as we'll see in a moment, um, where our forecast for overall sector growth and performance within this year and the next is still quite pedestrian, just as is pedestrian as the outlook for the wider UK economy as well. So in terms of the balance between the wider UK economy and the sector, it's not necessarily peeling away at any degree of speed, but it's keeping in line in both senses. However, neither is particularly exciting, as is the mood music at the moment. So if we could have the first slide, please. So what we'll do, as per usual, I'll just give you a quick overview, and then we'll go into interrogate some of these metrics one by one, with some illustrations that should add some color to what I'm talking about. So output and orders, you see, are pretty flat. Marginally contract on balance. What that means, that implies that they contracted compared to the last quarter, which is true. But in terms of, you'll see it's actually quite stark, the performance of last quarter's output volumes in terms of the balance figure as opposed to this quarter's. Inflation, in terms of the price setting behavior, we actually have our price setting behavior, that's the third point there, coming down. However, it's that future expectation that always ekes a little worry into our outlook, where the sector suggests, well, perhaps on balance, the proportion of the sector that's raising their prices this quarter is coming down. However, next quarter, the sector expects that a greater proportion will start increasing those prices. It's been that way for quite some time. We wanted to say, really, throughout the entirety of 2024, that all the sort of the pricing anxiety has gone to bed. We've not been actually quite been able to say that, even though price setting behavior in terms of the proportion of the sector that is indicating that they're raising their prices has come down massively over the past since just over a year ago, and you'll see that when we get to that slide. We still have certain anxieties about it could pop up anytime, sort of any time within a 3-month period. And the sector seems to think that as well, as indicated by their future 3-month expectations, that it may well pop up. Margins aren't performing particularly well as a result. And what we see, and we'll see this in the illustration in a moment, is that when those prices pop up in the short term, we see margins recover sort of naturally because they're linked. But what that might mean for longer term 2025 pricing expectations is yet to be seen. Employment's a really big one here, of course, because as Richard mentioned at the start, we've had perhaps the most visible change to the business environment, or the most immediate change to the business environment has been seen in terms of those national insurance contributions that have sort of been infamous within the SME, and particularly within the manufacturing sector, but particularly within the SME community. That too compounded with the slightly less visible changes to the employment rights bill that are working their way slowly before they start coming into legislation in 2026 and beyond. Those will be having a double impact on employment decisions that the sector will be making, and inevitably these changes will increase the cost of employment and reduce the flexibility in employment that is afforded to the sector. We've talked about confidence there. I mentioned those forecasts, and you can see at the very bottom there, minus 0.5 for manufacturing GVA at 2025. This is the first forecasting round of the year, so it is still very due to change. With such a sort of flat expectation of minus 0.5%, within margin of error stuff to zero there, it's quite likely we'll see that revised. At this moment, I normally have an indication as to, we'll revise it. It's more likely to be revised up more than down. I think our mood has improved a little compared to perhaps about 2 months ago, but certainly not strong enough to move it by even a whole percentage point. But as you can see there, in terms of scale of growth between the UK GDP and the manufacturing GVA, it's not a million miles away. And I would invite you to not draw too many conclusions about the UK GDP as a positive one, whereas manufacturing is negative 0.5, especially in the first quarter of the year, even though they do have a sign difference there. If I could have the next slide, please. Just gonna pop that away. There we go. So output and orders. I mentioned this, and you'll see here, if we look at the far right, and just a health warning I usually give is what you're seeing here is not to be interpreted as an absolute change quarter on quarter. So where you might see a bar at, say, 20%, this does not indicate that in that quarter output grew in the sector by 20%. What this represents is the balance, or the proportion, essentially, of the sector that saw their output increase or decrease, or orders increase, decrease relative to the previous quarter. But now looking here at the far right, this is this quarter's data from Monday, 25 Q1. We can see 2024 Q4, we saw quite a boost in output and orders, particularly in output that we weren't really expecting. A bit of a Christmas rush and a seasonality that the sector had expected, but we thought they were over-egging it at the time. Now we come in here and it's underperformed those expectations, and actually we see orders in a contractionary position that we haven't seen for quite some time. If we just look at this small time series here that covers about 7 or 8 years, this data, as I always say, goes back in its form 30 years. But just visually here, you can see that orange bar is in contraction, which it hasn't really seen that level of orders contraction since the bathtub around 2020, around that COVID time. It's not super severe, so I don't want to be sensational and say you could get away with a line saying that it's a level of orders contraction that we haven't seen since the period of COVID. I think that invites some conclusions that are more pessimistic than reflects the reality as we're seeing here. But still, it's impossible to avoid the objective statement that both those bars are negative, and they haven't often been since way back in 2020. So if I go to the next slide, please. Now, this is a breakdown of that orders bar. So we're looking at UK orders and export orders. And as has been the case for pretty much throughout the entirety of 2024, if you just ignore the green box bar on the far right for a moment, I'll get to that in just a second. But you can see actually that where the balance of orders has come in, it's export orders that has been propping up the total figure. Although the total figure has been rather diminutive, nevertheless, it's those orange bars, time and time you can't even almost see those red bars in some of the quarters that have been, the sector just has been propping up those books. So that's an interesting observation there, that even in 25 Q1, so this quarter, Monday's data, we see that actually it's the UK orders that have entered far more contractionary territory, and export orders are just surviving with a positive balance figure there. And depending on the resolution of your screen, you might just be able to see a small orange slither above the 0 mark there, above the 2025 Q1 point. But moving on to that green box bar, this is what I was talking and alluding to earlier with regards to that future expectation. So this isn't our forecast. This is the sector's when we take this when we do this field work. We asked the sector how they feel about the coming 3 months, i.e. the next quarter. So that will be 25 Q2. And you see we have quite a high expectation. Now, this has been those of you that have seen our past couple of quarters have known there's been quite a common phenomenon consecutively where the sector overestimates or perhaps is quite hopeful for what's around the corner with regards to performance that doesn't quite come to pass. And we'll have a little look at that on the next slide, please. Now, this is a marrying up between those expectations for output and orders versus what actually comes to pass when we get the sort of retrospective data in. Now, if we're looking at the far right here, and you can see there's been a sort of a mishmash of over expectations with regards to output and orders over the past year. If we look at the far right and you see the bars, 24 Q3, 24 Q2, 24 Q1, you can see the bars are higher than the dots. And effectively, the dots are where that data came in retrospectively, the truth, and the bars are those expectations that were set the quarter before. Now, we see here in 24 Q4, as I mentioned at the start, that actually performance for the first time in a while actually outpaced those expectations. Expectations were far more sober than they had been in the previous few quarters, and then actually performance exceeded that. But here we are sort of back to those business as usual expectations in 25 Q1, where the expectations set just at the turn of the year last year were thought to be fairly positive and indeed outperforming what had just been posted in 24 Q4. But then actually what has come to pass, as we can see on the dots below the 0 line there on the far right, has actually come in far beneath those expectations. So, what does this mean? Often what this means is, seeing as we've seen this overconfidence for so long, there's something going on with the sort of around the cornerness of these expectations that the sector is indicating that, any moment now we'll see a return to more steady growth. But in the short term, with this another sort of failed expectation not being met, so the performance not meeting those expectations, we can expect to see, some impacts to things like those longer ambitions on investment and things such as that, which we'll see in a moment. Could I have the next slide, please? Now, looking at pricing and margins, I think probably one of the most important sideshows of this work, particularly given the pricing spiral that went on, as you can see quite evidently visually between 21 and 2023. And you can see this been steadily coming down. Again, as with all these are balance figures. These don't represent an absolute change per quarter in terms of 40% uplift in price. It represents the proportion of the industry that have suggested that they have raised their prices relative to the last quarter or not. Now, you see here just to the left of the green box bar, we can see this is UK price setting behavior and export price setting behavior. See sort of steadily coming down and indeed getting to that point in terms of the average levels similar to pre-2019. If we just sort of look at that chunk between 2016 and 2019, we're not a million miles off, and we've certainly come a long way down from those highs of 2022. Those of you might have seen this, heard this from me before, but the levels we saw in 2022 there, those highest points, is the highest balance figures for pricing there's ever been recorded in manufacturing outlook's just over 30-year history. So that mountain there is the most mountainous of them all in that time series, going back all right the way back. In the green box bar, this is that future expectation for price setting behavior. So that's what I mentioned at the start and was alluding to about slight cause for concern still exists about, despite the absolute in terms of the recorded retrospective levels of price setting behavior coming down, we see in the green box bar the sector indicating that actually next quarter the price setting behavior might climb quite significantly. Now, how do we get the truth out of this? Because we know, given some of the other metrics, we've seen quite a lot of overestimation from the sector with regards to the performance of other metrics. So I think I would also recommend taking this expectation with quite a pinch of salt as well. But interesting nevertheless. Now, with margins, which are represented by the light blue line and dark blue line for export margins, you can see that this quarter, despite price setting behavior sort of taking a steady step down from the previous quarter, we see margins take quite a dip. Now, what this is the manifestation really of increasing costs for the sector, production costs, without the commensurate increase in pricing, leading to that short-term divot in margins. As has long been the case, if we look at the margins lines as they go under the green box bar, the sector is always quite hopeful that next quarter margins will just move up again, whereas often that doesn't tend to be the case. And that's why we've seen really for over 2 years, since about 2022 Q4, you can see margins, particularly with export margins is a better indicator of this, but they've remained pretty steadily flat just beneath the zero line. So just sort of consistently in that contractionary territory, which indeed does unfortunately marry up with our understanding of cost pressures being extreme where the bathtub is in 22 Q2, but not actually abating at the same rate as perhaps is colloquially understood for the sector. For the next slide, please. Now, confidence, quite interesting, and this is quite an encouraging moment in amongst some of the slightly sort of darker, more pessimistic tone I've been taking. Now, last quarter, 24 Q4, if you look at the far right, we see had a serious dip, particularly in UK economic conditions in terms of the sector's view on UK economic conditions, but also a dip in the sector's view on its own performance as represented by the red line business performance. And actually, in terms of the speed of that dip, again, I'm going to go with, cherry picking data lines, but it was the strongest dip since COVID, since the post COVID summer 21 Q3 there. After what was a remarkably long and consistent period of growing confidence, which is between 22 Q4 since the start of 2023 and since 2024. You can see that sort of steady, strong growing line. I should also mention this is a diffusion index, which is a silly word for above 5 means positive on aggregate and below 5 means negative in terms of that confidence. But we see here now in the first quarter of this year, that negativity hasn't continued despite the output and orders data that I showed you in the very first slide and in my preamble. We see that orders and output performance has come in quite well, hasn't come in that negatively, but it's come in well beneath expectations, and it has finally moved into negative territory, unlike what we've seen for some time. Yet confidence has stomached this and actually just ticked up a little bit, which is encouraging and should hopefully offset some of the negative impact that we'd expect to see in those longer term investment intentions, which we'll talk about now on this next slide, please. Employment and investment. Now, I'll start with investment because I think this is, I've just been talking about it, so it's fresh in the mind. Orange line. Now, this it represents the future 12-month investment intention. So this is the only metric that we measure that isn't on a rolling 3-month basis. It's listed on a rolling 3-month basis, but it's asking about the future 12 months because it would just be a little bit too volatile to be looking at investment intentions on a 3-month rolling outlook. Now, where that orange line just goes to 25 Q1 there, you can see on the far right, a slight dip. And you can see the investment intentions metric in general has been in somewhat of a holding pattern since 2023. Quite, I suppose, despondently, not massively and positively impacted by serious changes in the business investment policy landscape, vis-a-vis, full expensing at the time, way back when super deduction, the permanency of the full expensing and the permanency, increase of the AIA to I think £1 million or whatever it was. Not having that sort of significant uptick that we'd expect to see. Of course, investment intentions will be overwhelmingly driven by the prevailing economic conditions, but we see here a downturn, and so we're at the lowest level in terms of that balance figure for investment intentions as of Monday's data since 23 Q1, where we saw that dip below the zero line. So that's not massively encouraging for the sector, particularly where we have a current forecast at the first quarter of the year that's already so pedestrian. That one of the strong drivers that would see that grow out as the year progresses would be a greater intention to invest throughout the year. Now, unemployment, quick mention on unemployment, that's the red bars. I see employment on balance suggests it contracted a little. This is to be expected. This isn't a mega change on quarter, but we'd be surprised if we saw a massive expansion in employment, particularly as April looms and large companies will have got their ducks in a row as per the announcement around the changes to NICs. But smaller companies will be slightly later to that raffle, and perhaps even post April, we might still continue to see those effects of the enhanced cost of employment and the subsequent suppressive effects that will have on employment activity within the sector. For those of you that are interested, I might make a calculation show that for the median manufacturing employee within the sector, the NICs change will add a further £971 per annum to the cost of that cost of employment. So just for easy maths, call it £1,000 per employee, which gives you a sense of while a relatively small amount per employee. Obviously, if you're an outfit where a large company with hundreds, that's a significant implication on even short-term cash flow as well. Now, quick mention on that green box bar, we can see employment actually the sector not expected to continue decreasing its net level of employment. However, again, these green box bars, as we say, we have to take with a pinch of salt because we've seen some overestimation elsewhere with regards to that. And actually, with employment, this can often illustrate more so the vacancy rate or represent a skill shortage within the sector, less so about how much the sector actually expects to hire in the coming quarter. If I have the next slide, please. Now, what we're looking at here is just a visualization of those forecasts. We've talked about these enough, so I'll just run over these. I think the most important thing to take away from here is that they're not a million miles away from each other, the manufacturing forecast and the UK GDP forecast. And I would not get held up in the fact that the manufacturing forecast for 2025 has a negative symbol in front of it, but UK GDP has a positive, because they're still within, especially in the first quarter of the year, well within that the margin of error territory. And for 2025, we're only in the first quarter now. And the next and final slide, please, which is the exact same as the first slide. I think I've talked a lot here, and I think I'll just give you two things to take away, which is that it's rather confusing, as I think no doubt I've probably confusingly communicated to you today, that we've had output performance, the core metric performance, come in beneath those expectations, come in at a slight marginal negativity, but at the lowest level we've seen for a while. Yet at the same time, we have confidence growing. So I think the sector itself is a little confused. I think it's probably quite all to play for in 2025 with regards to that performance, because when we see that match between confidence going up, investment going down, but output and orders going down a bit, but the expectation around the corner is that by next quarter we'll grow, it leaves it in that territory that makes it quite hard to observe any core trend the way we're definitely growing or declining. And I think that's frankly represented by the forecast as sort of at around the zero mark as well. So what I can say is I can't guarantee which way it's going to go. I think it's very likely we'll see the 2025 forecast for manufacturing GVA revised. In which direction, yet to be seen. Anyway, thank you very much. I'll hand you back to Richard now.
Thank you, James. Classic Economist conclusion there of it's going to change, but I can't tell you which direction. So, so it's like, yeah, can't forecast anything, but I can tell you why it happened historically. James, thanks you very much for that. It is interesting that that there is kind of this, I don't know, for want of a better phrase, the Del Boy phenomenon in terms of outlook and confidence. That confidence metric, which says, everything's going to be bright, sunny uplands tomorrow. But when you look at the hard figures and the intentions around investment and employment, then that shows a slightly different thing, and the orders obviously coming down. That's the main thing that's kind of slightly concerning. But there is kind of a slight disconnect between the two, and I do wonder sometimes whether it's the fact that manufacturers just are used to, I guess, change happening around them, and they know they can get through it, but they'll work it out as they go along, rather than having a longer term view on how things are going to play out. But just on that, I mean, I guess the other thing is when you are, depending on what time of the day it is and whether somebody's had a good cup of coffee or a bad cup of coffee, can quite impact some of that kind of confidence index as well. So have you got any thoughts on that as well? I mean, obviously you kind of said, well, it looks a bit of a disconnect, but any other observations on that?
Yeah, I think the major thing is, I'm less concerned in the short term when I see, output. The output in orders is, well, volatile just by nature. That's what the data is. Confidence, as you correctly sort of observe, is very volatile and can be influenced by, whether the nation's in a good or bad mood in that week, whether it's, the bad budget, the good budget, whatever's going on. The more concerning thing for us is seeing that those investment intentions, those 12-month investment intentions, because a bad quarter of output performance is irrelevant in the face of a strong combination of confidence and strong intention to invest. That becomes down, and in the reads, it's a short-term, 3-month figure for output or orders. But if we see consistently suppressed investment intentions, then there's little hope to see the GVA forecast to be revised upwards, because where could it possibly come from unless it's coming from a magical boost in orders from the kingdom of never come, when it's not being built in at the ground level in terms of that capacity increase.
Yeah,
You combine that with a slight decline in employment as well, it's going to make it even harder, even on a mathematical level, for the sector to grow with a declining level, a marginally declining level of employment, but also decreasing investment. So,
yeah,
if you had to press me on which way I think it's going to be revised, it'll be probably at the start, at least for the first couple of quarters, there'll be downward pressure on it.
yeah,
Um,
yeah. I tend to agree. I think the other thing is that just in terms of productivity, that there's kind of the cynic's view of the world that kind of says, actually what we want is high quality jobs. It's not the number of people employed, it's what they're doing. And how do you drive productivity? The answer to that is typically through automation. So, is there a drive towards further investment in automation to allow us to have higher value employment within manufacturing? But at the moment, that investment indicator is the worrying one, I guess, in that respect.
I'll just add one point to that, which is, depending on how clever we think the policymakers are in Downing Street, it is thought to be the rationale, one of the side rationales at least, of the NICS change, because of course the NICS change, and I'm not a tax specialist, but I do know this, that the majority of the NICS change isn't coming out of the rate, it's coming out of the tax-free allowance that is within before you have to start paying NICS, which means effectively that it disproportionately costs more for lower paid roles.
Yeah,
So
yeah,
effectively,
exactly.
it punishes the holding lower pays rolled. And
Yeah,
so the idea being is that is this a piece of 4D chess to tax away lower paid roles and to focus on higher paid roles, and then vis-a-vis increase automation through that process.
yeah, yeah. It all depends on what view you have on the world, but yeah, it does feel like that there is that kind of potential underlying intent sitting around that as well. James, thank you very much for that. And we'll pick up on some of those points in the panel session. So if we move on to the next slide, as I said, I'm going to be joined by Richard Dammermann, who's head of our cash and working capital management here at BDO, and also Stephen Cooney, who's principal in our value creation services team at BDO as well. Basically, the intention is to have a conversation about what can businesses do, because clearly when we look at what's just come out of the first quarter's results, plus, as we're saying, NICS is going to be kicking in beginning of April, which is going to have quite a significant impact on people's cash and profitability. is making sure that businesses, one, are ensuring that they are maximising availability of cash to be able to cover some of these changes, but also making sure that the business is set up for success. So its operating model and its profitability is maximised during this period to ensure that the winners in the sector really have a proper, I guess, baseline and investment case to both weather anything that may be coming their way, but also more strategically think about what they should be investing in the future. And that's even before we pick up on the conversation around industrial strategy that everyone's looking forward to seeing. The question is what's in it and what's available to provide certainty for manufacturers as well. So Steve and Richard, thank you very much for joining the call today. Just on that sort of tack, I'm going to throw it out there. Steve, I'll come to you probably first. But in terms of those challenges around both operations and working capital, in terms of what you're seeing and what people are doing around some of the challenges that are coming up and probably have kind of existed in some shape or form since COVID, be good to get your thoughts on that.
Sure. So just to introduce myself, so I've probably got 25 years of experience of working in the manufacturing industry. So working within manufacturing companies, doing shop floor-based performance improvement projects, transferring production from one location to another, closing factories, and then I guess more laterally working in an advisory capacity for private equity houses, lending banks and management teams on transactions and distressed cases. So I'd say, most manufacturing companies will have a plan, and what they're not liking at the moment is a lack of certainty regarding some of these kind of like strategic impacts that are happening in the world. But I'd also say, from my experiences and my first kind of jobs in manufacturing, is you've always got a kind of plan to take cost out. Certainly, my first job, we sold products to automotive manufacturers. And the OEMs, we signed contracts where we were giving price reductions of, say, up to 5% year on year. And as a job as a manufacturing engineer, it's your job to try and make your production costs lower year on year to maintain your gross margin. So I think lots of manufacturing companies out there have got plans in that pockets, whether it's kind of like more strategic investments for new assets and production equipment, or whether it's kind of like more simpler stuff. They've got a plan to actually address these actual challenges going forward. So I think that's what we're seeing quite a lot of our clients. They're continuing implementing some of these subtle changes to preserve their gross margins, Richard.
Yeah. Thanks, Steve. Yeah, I totally agree. I mean, Richard Dammermann, coming to you, obviously from a cash and working capital perspective, changes in NICs, £1,000 per head per employee kicking in as of the first week of April. That's quite a significant hit in terms of cash flow. It'd be good to get your thoughts on that as well in terms of I guess the challenges and I guess what people should be thinking about as well in terms of maintaining cash position. Would be quite useful.
Absolutely. So I will also introduce myself, Richard Dammermann. I lead cash and working capital management for BDO, as Richard mentioned before. I've been specialising in working capital improvement for about 16, 17 years now, cross-sector, but a lot of experience in manufacturing. And of course, what is core to working capital is the operations of a business, and that manufacturing cycle of a business is core. So there's an element of manufacturing production in pretty much every single working capital project that I have done over those years. So challenges in the manufacturing sector at the moment, you're absolutely right, Rich, sort of that increase in input costs, so labour increase kicking in April, but also potential increases in shipping costs, well, definite increases in shipping costs as we've seen recently, but potential additional pressure there, and import-export costs, potential tariffs in this environment. So a lot of pressure on margins and on cash flow. And from my experience, the manufacturing sector is the prominent sector in the UK where the need to invest is absolutely critical in order to stay competitive. So to be able to adapt to those pressures in order to be financially resilient, to help grow those margins despite costs going up, investment is absolutely key. And yet we're in an environment at the moment where borrowing is expensive. Interest rates are very high. So our recent survey showed that more than a half of the respondents are anticipating further cash flow pressure, further squeeze on working capital over the next 12 months as a result of all of this. Now, you've also got to think that that is not happening in isolation just for manufacturers. Manufacturers have customers, they have suppliers. And across that whole supply chain, there's different levels of cash pressure. So what is quite interesting is that the survey respondents and what we're seeing in the market is that a lot of this pressure is coming less from supply chain disruption where we've seen it before, but the anticipation over the next 12 months is that it's going to be coming from those customers, from those suppliers who are looking to manage their own cash flow even more than they have done in this environment, trying to manage their own cost base. So customers are looking for more credit from manufacturers, suppliers are looking for quicker payments and shorter payment terms in order to manage their own cash flow. And all of that is adding then extra pressure onto the manufacturing sector.
It's there's quite a few things in there, right? If you unpick it, and if you think from a working capital perspective, obviously, you know, other sectors have other pressures, but the fact that you're dealing with suppliers, customers, plus production, WIP, finished goods, all the rest of it, stock management becomes particularly important as well. At the same time that you know, you're seeing the US, and who knows what else might come down the line in terms of tariffs and what the unintended consequences of that will be for the UK. There's quite a few things to think about, but that kind of focus on cash and maintaining cash wherever you possibly can and retaining it is going to be incredibly important. Like you say, interest rates are going up. You know, first question is, how can I fund investment through my existing cash pile rather than going out and borrowing money at what may be somewhat painful interest rates? It's going to be
exactly right,
really
and that's
important.
what's key, Rich. The cash is king, to use an old well-used phrase, but it really is. And so financial resilience in the sector needs to come from official cash management, efficient cash management, and understanding of sort of what levers can be pulled in order to build that resilience within the organization is absolutely core. And Steve mentioned it a second ago. Sort of manufacturing thrives on predictability, and there has been and still is a lack of that in the sector. So these manufacturers need to think about what is happening in the future. They need to plan, understand cash sensitivities, understand their cash flows, understand headroom, understand fluctuations, and importantly, know what levers they can then pull in order to sort of thrive during the period where there's a bit less certainty and a bit less control.
Yeah.
I mean, one of the things we haven't talked about is the actual different sectors within the actual manufacturing landscape. Because certainly, you know, a number of sectors, you'd say like the defence sector must be quite happy with the actual fact that defence spending is going to go up. That's probably going to drive a lot of growth and volumes in companies that supply into that sector. Whereas you look at other sectors like the automotive sector, that's kind of really struggling at the moment. Production volumes in the UK are half as what they were, say, compared to 10 years ago. And with the sudden influx of Chinese vehicles that are coming into the market, it's going to put further pressure on the entire sector. So component manufacturers that supply into the automotive industry have got a completely different set of issues to deal with versus, say, people that supply into the defence sector. So I think that's another thing that we're seeing with our client base as well. Depending on what sector they're actually supplying into, depends on how resilient they are to the actual issues that people are currently facing.
Yeah, I totally agree with that, Steve. Obviously, you and I went along to the Make UK conference a couple of weeks ago in London, and one of the breakouts was defence, and it was probably the most attended breakout of the whole conference. The place was absolutely packed, full of people trying to think about, hang on a second, what is the defence sector, and how can we get either involved or more involved in that opportunity? So it was quite interesting that that clearly there's an intent there. There's statements have been made around the defence sector. Obviously, defence covers more than just manufacturing. There's cyber security, all kinds of other things that sit in that pot. But being aware of what the opportunities might be, especially for mid-market companies, is going to be particularly important, because obviously most of those big bucket spend items end up with the big boys in the market. The question is, how does that flow down efficiently through to the kind of the SME market as well, to make sure that they are sufficiently represented in that defence spend bucket. I think the other thing is that most defence programs, not too dissimilar actually, Steve, to automotive, is those programs last 25 years plus, effectively. So in terms of turning the dial up or down in terms of budget, sometimes that takes longer than people initially anticipate. So it's very easy to grab some headlines by talking about it. The question is, what are the practicalities that sit around that?
And I guess one of the other things that uncertainty creates is around kind of like raw material pricing and contract prices. So obviously how you actually contract on that basis, where you've got a lot of fluctuation and variation with your input prices, is also a challenge. And I think we're seeing in general that contracts that are probably in discussion, etc., for businesses that supply into these type of industries. Contracts are being delayed. There's a lot more discussion going on in terms of getting those numbers right and the terms right.
Yeah, completely. I think that just we're hearing across the board that obviously the level of uncertainty around potential trade wars, etc., is leading to people trying to risk manage their contracting on both sides of the table, which is obviously delaying additional orders that may come through. So in principle, people kind of have agreed that they need to do something, but the risk management around that, the contracting, therefore the the actual timeline between kind of handshaking it and actually signing a piece of paper seems to have been extended somewhat. I mean, Richard Dammermann, that's probably one of the areas, obviously, when we talk working capital and cash, it's everything from how do we contract efficiently with clients to make sure that that is as smooth as possible. We get paid what we should get paid, all the way through to the other end of supply chain management as well. But it'd be good to get your observations on that.
Yeah, absolutely. I mean, any delay in the contracting process delays cash flow typically, so it'll impact your working capital, and you'll then need further investment in order to continue your operations, your standard level of working capital. And so I suppose we're seeing more and more manufacturers look to try and build closer relationships with their suppliers and negotiate improved terms, improved invoice frequency, invoice timeliness, and so on. But that's difficult when you've got these added pressures of, exactly as we just mentioned, those risks as part of the conversation, the prolonged contractual period, more worry around absorption of future potential changes and price changes and cost changes, all having to be built into these contracts. But at the same time, that delicate balance between cash flow and sort of and cash timeliness and price or cost within that contract, when typically it's going into that conversation with as much information as you possibly can in order to come to that balanced point, be as transparent and open with your suppliers to build that strong relationship. But that takes some time. And there's as I mentioned, more pressure on getting that balance right between good payment terms for your business, good invoice frequency, so that you can either collect or bill more on time, or you can consolidate your invoicing and pay your suppliers in a more structured way, but all going up in the same conversations and the same negotiation with then these broader risk issues in that contracting period.
Yeah,
So absolutely huge pressure.
There's a quite a bit of complexity in thinking that's required around that, and I think in the main, I mean, manufacturers are kind of used to juggling that, but maintaining sharpness on it, I think, is really important. The other thing that obviously sits around that is just how quickly businesses will need to continue to respond to impacts, right? So, you know, I guess we've been talking about this since the first days of COVID, but it does feel like, you know, the situation we're in now in terms of lack of certainty is somewhat reminiscent of what we went through a few years ago, and therefore having a sufficient way of anticipating things, scenario planning, and understanding what options you've got, so when something happens, you can pull the trigger on a decision, is going to be, you know, maintain its importance in terms of management. Steve?
Well, I was just going to come and say, going back slightly further than COVID to you know, the 2008 financial crisis. That's how long in the tooth we've been working in this kind of industry. But obviously, we talk about sales and operations planning, which is, for, you know, as people are aware, it's kind of like the certainty of what your manufacturing volumes are going to be for the coming months. And certainly the automotive industry has got a relationship with their suppliers of giving them known volumes, that there's very limited change to those volumes, which aid that kind of planning of efficient production and you know, investment profile, etc. And certainly when the financial crisis hit, it was very quickly to the stage where a lot of OEMs that had a 30-year relationship with their clients and their supply base suddenly turned off S&OP and said, "We've got no idea how many cars we're going to produce. We've got absolutely no idea how many cars we're going to sell," because of this uncertainty was so great. So all the rules that we've had before were just tearing up. And so if you're a poor component manufacturer, you don't know whether you're going to produce 100,000 components, 0 or 200,000. The actual change was absolutely phenomenal. And so a lot of suppliers became very quickly very distressed. Now, I don't think we're quite at that stage, but it just goes to show when that kind of uncertainty level ramps up and ramps up. And so I think now for manufacturers now, having a very strong, capable FD and finance team with the industry within your company is very critical. And also to monitor banking covenants is absolutely essential to make sure that you you realize that if you are going to get into trouble, you've got your early warning detection signs on, and you're having those conversations with your lenders very early.
Yeah, absolutely right. I guess the other thing, if we sort of talk about technology, because everyone gets excited about technology, especially AI, and everyone has a very different view of what that actually means and what it can actually do. But in terms of that whole opportunity for using technology to drive financial resilience, it'd be good to get your views on that. Richard Dammermann, if I come to you first, it'd be good to get your thoughts on that.
Absolutely, and it actually builds on very well from that conversation just then with Steve. If I broaden that question to technology and data, because I've done work with a few manufacturers recently where actually they just wanted to get a grip on their operational data to help with things like demand planning, to help with inventory management, and all they really needed was visibility and some analytics behind what they were already doing in their business in order to just make those tweaks to improve the effectiveness and the cash effectiveness of the business. But really, when you think of technology and manufacturing, to me, I suppose there's three elements. There's the data point I just mentioned, and the visualization, analytics, and the levers you can pull off that. There's then the technology and the actual operations of a business. So therefore, you're looking at systems and automation, and can you look to bring in the right sort of technology to your business? And this will be variable across the different subsectors within manufacturing, but also within the size and maturity of each business here. But it's relevant to an extent for all businesses in manufacturing, and manufacturing more so than most of the sectors. But bringing in things like automation in your or semi-automation in your billing and collections processes, in your invoice ingestion processes, your invoice coding processes, approval processes, just to take out some of that time spent and the delay in back office functions that can then help speed up the actual operations of the business.
I mean, it's interesting because we bang on about automation a lot, especially around manufacturing. Now, some of that is, when we're talking about that, requires quite a significant amount of investment. And there are other areas where it's just, we've got a repetitive process here. We can do something that is far more process driven, but doesn't require exactly. And that's one thing that I think is really important to underline. Obviously, if we kind of go back to that conversation I was having with James around, if we need to, as an industry, to increase our productivity, that has to come from using fewer lower skilled people and using automation to kind of drive towards higher value roles, but also greater output per input. Steve, it'd be good to get your thoughts on that as well, especially when we see in this quarter that the investment intention seems to be dipping somewhat.
Well, I guess it depends on the type of manufacturing business, because I suspect there are some manufacturers on the call that turn over probably 30 or 40 million pounds with 3 people in their finance team, probably kind of slightly struggling to understand how AI is going to transform their kind of like back office processes, etc. But I guess, if you're a much bigger manufacturer with multiple manufacturing sites turning over 250, 300 million, then all of these kind of like back office efficiency, etc. measures are actually appropriate. In terms of coming back to if you like, the general idea of what manufacturing investment can be, I think all manufacturing businesses that I've ever worked in, irrespective of what they turn over, have got a certain known investment they've got to undertake to replace worn out assets and develop assets and the like. But also they've got the kind of like the upturn investment as well, where they know where they need to drive productivity, where they need to improve their capability of their manufacturing assets to make more with less people to kind of like drive productivity. And I think that's where the opportunity actually lies. But just coming back to these, squaring the circle, what we were talking about earlier, if you've got the certainty of your kind of landscape you're operating in, you've got a certainty that your business plan that you put together and your manufacturing strategy that underpins that, you can then go on the journey of actually delivering that and be confident of making those investments and delivering it. I suspect that because you've got the element of uncertainty, you're questioning your business strategy, you're questioning whether you can afford to make those manufacturing investments, which probably ties up why we've actually seen a downturn in the investment confidence and the level of investments planned.
Yeah, I agree. I think I think both sort of quantitatively from the survey and qualitatively in terms of the conversations we've been having, is I'm going to sit on my hands till I get some sort of feeling of confidence that I can start placing some bets, knowing that they will, there's a good confidence that they'll lead to the correct outcome. I'm going to sit on my hands, I would think, just manage my cash pile and make sure I maintain the efficiency and continue with sort of no-brainer investment activity in terms of maintaining the status quo. But it does kind of throw up that question about what's going to come out of the industrial strategy. That obviously there was the consultation before Christmas. I think there should be some information coming out around that in the next couple of months. Obviously, there are certain areas that are have been mooted already. Obviously, defence is one area. The other area is advanced manufacturing. The question is, what's the definition of advanced manufacturing, and how will you actually support businesses around that? So it'll be interesting to see what the specifics are that people can actually start getting some certainty around, sort of longer term strategic investment rather than maintenance investment. I'll open it up to either of you to sort of comment on that.
Well, and also I think one of the other things that's part of that strategy is what strategically manufacturing capability do we want in our country? So I think a lot of people talk about the steel industry. The steel industry is in the press all the time. We've got our big steel manufacturer, British Steel, that's been, it's gone through various stages of being depressed, etc. I think if we genuinely want that kind of capability, because we see it as a strategic manufacturing asset and capability in our country, then that's what the industrial strategy has got to address and understand how we're going to actually be able to afford to do that.
Yeah, which it kind of comes out from some other conversations we've been having, which is advanced manufacturing is great. Absolutely, we should be going for that because it's higher value, higher margin, but that needs to be underpinned by some quite straightforward and more, I guess, more basic manufacturing that actually can underpin that advanced manufacturing. Otherwise, again, you're not really in control of the complete supply chain. So it's all well and good. Looking at crystal structures of steel fans or something like that, but you've got to produce the steel in the first place at the right quality and the right level as well. Gentlemen, thank you very much for that. Really useful things to think about. I mean, if I was to ask you to come up the kind of one thing that people should be thinking about over the next kind of, let's say, over 2025, what would your one thing takeaway be? I'm going to go to you, Richard Dammermann, first this time.
I would say don't be afraid to add some structure and control to the business through a level of investment. So you don't have to be scared away by talk of big industry change and Industry 4.0 and all of that, and AI, as Steve mentioned before. There are tweaks you can make to your business, especially from a working capital point of view, where you can use elements of technology. You can use better visualization, as I mentioned, some of the clients I've worked with, an understanding of your data to build in just some structural changes that make you more financially resilient. There's been a lot of uncertainty. Uncertainty will continue. It is part of the world that we operate in, and manufacturers know that pretty much more than any other sector. So just thinking about the plan and using your data and an understanding of your data and operations from a working capital perspective to make yourself more resilient to those changes going forward. And the tools are in your hands. It will fund itself without having to go out into the market.
Great, thanks.
Simply for me is have your plan B in your back pocket ready to implement. And when you're working up your plan B, don't just take your volumes down by 10 or 20%, take them down by 40% and work out how you're going to thrive and survive.
Yeah. Thank you very much, gentlemen. Great. Super. We've got 2 minutes left. James, if you want to join us again, I think we've probably got enough time for maybe one or two questions that may have come through. Bal, are you with us with your list?
Yes, I am. So we've had a few questions come through. So firstly, during the panel session now, and I'll pose this to James, are you seeing much onshoring into the UK given the shifting global environment?
Yeah, in the long term, over the past, I say long term, over the past, 3 to 5 years, I think that the short answer is yes. I think that's driven by a lot of factors. I think one of the more driving ones, perhaps we followed here in the UK what similar happened in the US with the Inflation Reduction Act, which is a complex piece of legislation, but just in short, one of the key features of it is effectively you won't be eligible for any domestic incentives if not just you, but your supply chain is involved in countries that are deemed effectively unfriendly, which is where this friendshoring thing came in, and sort of the elephant in the room there is encouraging supply chains away from China. That was the case with the US economy. Now, here you see some similar things with the Eurozone as well. I forget the name of it because they changed its name. It used to be called the UNZIA, the European Union Net Zero Industries Act, which sort of was a bit of a copy paste on a much smaller parcel of funding, but around the same sentiment of you're eligible for these tariffs as long as your supply chain's located within the certain approved areas. I think what may change this, or we saw a lot of conversations about getting ready for any change, was a lot of the current US tariffs and a lot of the uncertainty around that US tariffs, how much of them are cutlass shaking and how much of them are going to manifest. One of the big questions that members are coming to us about was of course that conversation and that the sort of, again, the cutlass rattling that was going on about the potential scenario where the EU would see US tariffs, but the UK may not. Now that would have significant implications for production bases, particularly in terms of diversion of trade, relocation of especially those multinats, whether they might set up in the UK as opposed to the EU if they were big traders with the US, so on and so forth. But as well, critically, with China. So while the general trend has been back towards China, if tariffs were to hit both the European Union and the UK, which is looking progressively more likely more unlikely, sorry, I should say, as the weeks trail on. There was some risk there that we saw members talking about. Well, we have operations in the Far East. We may put the future investment into there just to not just mitigate the uncertainty, but if these tariffs were to come into force, the production cost increase would vary. And we did some modeling on this, anywhere between 12 and 17% increase in just production costs, just because of the nature of the supply chains being so intertwined. So in one answer to that question, in one succinct sentence, sorry, it's been everywhere, I would say yes, but the tariff uncertainty has slowed down that a little bit.
Yeah, I think just sort of pick up on that as well. Obviously, we've also seen Chinese manufacture, some of the sort of base manufacturing that you expect to come from China has moved to other areas of Asia. So areas such as Vietnam, etc., are kind of picking up additional volumes of work. So you can, legitimately say, well, we're not actually sourcing anything from China, but we are sourcing stuff from Vietnam, etc. So there's that ongoing. But I think, yeah, the answer to the question is yes, to a certain extent. But again, if you decide to start sort of nearshoring or onshoring activity, you need to have a certainty that the status quo will remain for a while. And I guess that's the other question that people may well be slightly uncertain about at the moment as to, is this going to continue, or does it really make sense for me to nearshore? I think the other point, I guess, is you really need to have a portfolio view to this as well. So you probably need to think about the balance between nearshoring, certainty of supply, etc., and cost. The cost question is the one we don't know the answer to at the moment in terms of how things are going to change. Richard Dammermann or Steve, do you want to chip in as well, or should we move on to one last question since we're 2 minutes over? Should we go to Belle? Have we got time for one more question?
Yeah, no, absolutely. And I guess this is for Richard Dammermann. What are the most common working capital improvements you see with the businesses you work with in the manufacturing sector?
Well, I touched on a few of them during this webinar. So visibility of data and analytics into that data. So things like using a bit more science behind demand forecasting, more science like the Monte Carlo simulation sort of methodology behind optimal stock levels that you're holding, looking at consumption and then lead times and customer service levels, all of that. So using the data that's there in the business, gathering it and analyzing it is present in pretty much every working capital project I've done within manufacturing. Building on that, there's often an element around culture and governance, and I think that is very key at the moment, of drilling into the mindset of the organization that cash is very important. It's critical. We can't go externally for it, for an on-tapped supply of cash. We need to be thinking about how internally we're managing working capital. So some of the messaging, governance, guidelines with organizations around how everybody within the organization, not just finance, has a role to play in efficient cash management is also a big part of projects. And then supplier negotiation is a big part. Toolkits, I touched on it earlier around the protracted contracting conversations with the new sort of risk elements involved in it. But building a balanced scorecard of information, a full toolkit of information to go into those contracting negotiations is another key element that we've been helping manufacturers with.
Great. We're kind of like 4 minutes over already, so I guess we should draw things to a close. But I guess in terms of the quarterly report, there are some things that need to be thought about. Two, The question is, what's actually going to come out of the industrial strategy that either provides certainty or not? 3, there's continued uncertainty. I think that message around looking after your cash and also having a plan B that Richard Dammermann and you, Steve, talked about continues to be absolutely correct, and really being quite brutal in terms of what may happen, and understanding what you will do in those situations is going to continue to be critical. But with that, I'm going to say thank you very much to gentlemen for joining me, and thank you for everyone on the call for joining as well. But Richard Dammermann and Steve, thank you very much for your insights around working cap and operational improvement. And James, thank you very much for joining us again to kind of talk us through the latest. Let's see what happens in the next quarter. See if that trend continues. Classic economics kind of position of going, we got one data point, we can extrapolate that in any direction you want. Let's see if we get a trend on the next one. Thank you very much, everybody, for joining, and we'll be repeating this in 3 months' time. Thank you very much, everybody. Cheers.